And welcome to the Aaron Katsman Show. I'm host Aaron Katsman. We speak about your life, your money, and your investments. And as always, we're coming to you from the spiritual and soon to be financial capital of the world, Jerusalem, Israel. If you like this content, please hit the like button below. If you've not yet done so, please subscribe to both the YouTube channel and to the podcast. And if you think somebody may find this of interest, why don't you go ahead and hit the share button and you can share it with them as well. So I came across an article by Ben Carlson called Creating the Perfect Portfolio. Why do I find this interesting? Is because it's almost like certain financial planners or asset managers might be coming around to stuff that I've said for decades. He starts off like this. He goes, a reader asks, when I opened a Roth IRA in my early 20s, I went 60-40, right, that type of portfolio, a moderate kind of portfolio, because a 100% stock portfolio felt reckless, even though I had 40 years ahead of me. The Scottrade rep helping me at the time actually chuckled and tried to nudge me toward more stocks. I knew the math favored them too, but bonds just felt safer. What's the argument that actually moves the needle for a young investor who intellectually gets it and has even been told directly, but emotionally still can't pull the trigger on a stock-heavy portfolio? Then he brings sort of the counter to that, somebody who is in their retirement who also has, who wants to have an all-stock portfolio as opposed to sort of taking the foot off the gas pedal a little bit and getting a little bit more conservative. So he says like this: we have a young investor in their 20s who is more conservative by nature and invested in a 60-40 portfolio. We have an older investor fast approaching retirement who is more aggressive by nature and wants to invest 100% in stocks. On paper, these investors are completely backward. Your biggest assets as a young investor are time and human capital. When you have multiple decades ahead of you to save, invest, and deploy your capital, you cannot invest aggressively enough. Your biggest assets as a retiree are financial assets. You have more to lose. This is why most investors begin a glide path toward more conservative investments with a portion of the portfolio that lead up to retirement. On paper, the young person should be the one with 100% in stocks, and the retiree should be the one with the 60-40 portfolio. This seems suboptimal and even irrational in some respects. And then he says, here's the thing, every investor is irrational in some ways, and that's okay as long as you understand the trade-offs being made. You can have a balanced portfolio in your 20s if it helps you sleep at night, but the opportunity cost is a wonderful long-term returns in the stock market. Now, this is what I want to speak about, okay? Because ultimately, it's not about the textbook. I've said this thousands of times. I've said this almost every meeting that I have. Whether I sleep well at night or not, knowing that I have the responsibility of hundreds and hundreds of clients' money that I'm responsible for, that's one thing. But you need to be able to sleep well at night. And if you start getting nervous and agitated and don't sleep well at night, well, you know what? It's not worth it. Your health is worth a lot more than any dollar value. That's not where he took it. That's not the direction he took it. But this is what I'm saying, because I also deal with living, breathing clients. I go back to a story that's now nearly 20, it's over 25 years old. Holy cow. Time definitely flies. I know when you look at me, you can't tell. I don't look any different than I did 25 years ago. But this story happened 26 years ago during the dot-com bubble, when somebody who actually turned into be a very, very good friend of mine would literally, while the market was crashing, after the bubble burst, would call me hyperventilating to know what was going on with his portfolio. And I said to him, you know what? It ain't worth it. Move all of your money into treasury bond. Now, that would have actually been a really good solution, but he didn't do it. But there was more slightly in jest. But the point was, it's not worth the anxiety, the stress, potential heart issues, hypertension. It's not worth it to make a couple extra bucks. I don't care what the textbook says. The textbook says when you're old, when you're young, I don't even care. It's somebody in their 20s. That doesn't bother me, right? I'm just using that as an example. What's important is that you have a portfolio that you can sleep well at night with, knowing that if the market drops, over any night, 3%, 5%, whatever it is, you're okay with it, right? If you're 100% stocks. And if you're not, and you can deal with a 2% drop. So, 50-50 balanced portfolio is more up your alley. And that's where it gets really, really important. When you're speaking, either when you're doing it yourself, and this is where people mess up all the time because they follow what the textbook says or where they find out online that you're young, 100% in stocks, even though they don't have the emotional, psychological makeup to have a portfolio that is on the roller coaster, let's say. So it's up to you when you work, if you have work with an advisor, to really sort of flush out, how you deal with risk what your approach is to risk. Because when things are going up, as they say in the local vernacular, sababa, right? Everything's great. You don't have anything to worry about. It's fun. It's easy to make money when the markets are going higher. But when you have to show your mettle, your moxie, that's when things are dropping. And how are you able to withstand that? Do you not pay attention? And you're really in it for the long term? You don't even know what's going on? That's one approach. If you're hitting a refresh on your computer every 3 minutes because the markets are dropping and you're starting to get nervous, then probably, I don't care if you're 20 years old or if you're 90 years old, you shouldn't be in a 100% stock portfolio, okay? It's part of it is what your goals are and your needs are. We speak about that all the time, right? That your asset allocation, right, the mix between stocks, bonds, cash, real estate, whatever it is, should be a function of whatever your goals and your needs are. But there's another factor, and that's your own ability, let's say, I would call it just the sleep test, right? Will you have a good night's sleep or not? Assuming that you're able to sleep regularly, right? If you wake up, if one of those people go sleep at midnight, wakes up at 2 a.m., that's something different. You're not sleeping well anyway, not because of your portfolio. But if it's your portfolio-induced lack of sleep, take your foot off the gas pedal a little bit. Because like I said, your health is worth a heck of a lot more than a couple bucks, even tens of thousands of dollars. So what? Okay, let's say you make another over that same time period, you're in your 20s, right? And the difference turns out to be $400,000, $500,000 even, which I don't think it is, okay? Between a 60-40 portfolio and a 100% stock portfolio. If you end up having a heart attack or other stress symptoms, is it worth it? Could you put a price tag on your health? I'm just throwing it out there. I don't know the answer. Everybody has to individualize it, right? Internalize it for themselves. I know my personal answer is that health trumps all. Certainly trumps money. Okay, maybe that's not maybe that's not where you're holding. That's cool. But know yourself. Think about it. Nothing's going to happen if you take a few hours or days and just ponder. Try and find the sort of equilibrium, between money and your health and your well-being, because it's worthwhile, right? At the end of the day, if you're sick and you're not well and you have billions of dollars in the bank, who cares? Doesn't help you. You're not going to get buried with your money, and you're not going to be well enough to actually enjoy and use your money. So what's it all about? Think about that. Okay? This is all food for thought. Okay? I'm not telling you what to do. You have to come to your own conclusion because you have to know yourself. It's really important that you are honest with yourself. Too often I've seen people not honest with themselves, and those are the ones who are always calling me when the market drops, just by chance. Okay? So think about it. How much risk should you have in your portfolio? Okay? And how much return should you sacrifice in order to sleep well at night? You've been tuning into the Aaron Katsman Show, where we speak about your life, money, and your investments. If you like this content, please hit the like button below. If you've not yet done so, please go ahead and subscribe to both the YouTube channel and to the podcast. And if you think somebody might find this of interest, why don't you go ahead and hit the share button, and you can share it with them as well. Thanks so much for tuning in, and we'll speak to you soon.